is Tesla a margin story?
These margins are dropping.
Deterioration of margins from last year.
Yes, it's hurt their margins.
Automotive gross margin.
Margins.
Bottom for margins.
Concern about margins.
Which would hurt margins further.
In this video, a lesson in how to miss the forest for the trees. As we saw in the intro there, the finance media and many on Wall Street focused on just one thing, the extremely short-term Tesla gross automotive margins. Right when you'd hope, and remember hope's not a strategy, but right when you'd hope, people are starting to go, well, hang on a minute. It kind of does seem like Tesla has an unassailable lead and are on the cusp of solving autonomy. What are the implications? But no, margins, and margins. Full disclosure, I'm actually fine with this. The less people who understand what's just around the corner, the cheaper I can continue accumulating Tesla stock with every spare cent. And just a reminder, if you'd like to see what I believe is around the corner and throughout the rest of this decade, head over to Patreon, check out my Tesla valuation model available to supporters at the investor level and above. I'm just kidding, you don't want to see my valuation model. Although, the last time I tried to warn people about an opportunity I thought they were missing is when I started this YouTube channel. Of course, I was completely off the mark and absolutely catastrophically embarrassingly wrong. I started this YouTube channel in November 2019. Tesla stock was about $330 per share. It's now a mere $260, so I look like a moron, don't I? Oh, hang on. Oh, I forgot about the stock splits. Yeah, I take that back. It's up about 12 times. But don't worry, that was just a fluke. Pure luck. I may have been right about the stock market not recognizing the opportunity and the insane amount of money Tesla was about to print. But on autonomy, I'm definitely wrong. They're not on the cusp of solving it. They don't have an unassailable data lead. And besides, it's not a decatrillion-dollar opportunity anyway. So ignore it. Don't sign up to Patreon. Don't look at the valuation model. Let's talk about Tesla short-term margins.
Tesla share is a little bit uneventful here in the aftermarket, but we do have the numbers, and we do have Mr. Ross Gerber with us this afternoon, President and CEO of Gerber Kawasaki Wealth and Investment Management. So obviously these margins are dropping. Ross, how much was expected relative to what they reported?
Well, I think they were kind of in line with what was expected, around 18 and a half. And, you know, that number is okay. I mean, we saw the deterioration of margins from last year, which was, you know, maybe a unique year, but it's also deteriorated a little bit from last quarter as well. So we're still seeing the pressure, but not as much so. And I think this could be the bottom for margins, which is very positive for the stock.
Well, what makes you think the bottom for margins, Ross? I mean, aren't they about to launch this Cybertruck? Isn't that going to be expensive?
Well, no, because, you know, that's CapEx spending that's been spent, you know, consistently each quarter. So as they're spending more money in certain areas, they spend less money in other areas because they were ramping Berlin and Austin last year at this time. So I don't see an increase in cost due to Cybertruck.
Wow. That's a big deal,
is out of line. Yeah, but, you know, they operate this way. It's very methodical the way they invest in certain things at certain times and then in other things so that it's not all lumpy. At the beginning of Tesla's history, it was a lot of investment up front, but I think now it's a very consistent investment. It's about $2 billion a quarter in CapEx they spent.
With the total operating margin, as you mentioned earlier, that you mentioned the automotive gross margin, right? In your statement, just to make sure we got them separate here, because the operating margin for the whole company drops down to like 10%.
10%, right.
Okay, which is a pretty big drop off from last year. Does it all come from the cuts to the prices, Ross? Is it entirely self-inflicted in your mind?
I don't know if it's self-inflicted. I think that things have changed from last year in a lot of areas, and certainly interest rates being one of them, you know, Elon's perception in the public being another one of them, along with just the fact there are competitors now that are maybe not like Tesla-like, but certainly, you know, you do have competitors, whether it be Rivian, Polestar, or whatever. So that said, Tesla sold a record amount of cars, and they just had to do it at lower prices. But I don't think they have to continue to do this, because the price of a Tesla is now within reach for a large amount of consumers. And my belief is that they should use other levers to sell, like advertising and things that I think will have a much better return than just lowering prices. So I think we got that through to Elon, and I think that hopefully is what they'll do instead of adjusting prices down, which would hurt margins further.
So I've actually been keeping count. We heard the word margin 69 times in that previous clip. I might have exaggerated slightly. And look, in fairness to Ross Gerber, he ain't the one asking the questions, he's just answering. But the point that I want to illustrate in this video, and boy is it going to age well, is that all of the discussion around Tesla right now, almost everywhere in the finance media, on Wall Street, margins. Not just any margins, but gross automotive margins, which are much lower than I personally would have expected at this point in time. However, I also didn't account for the fascist, futile, insane, inhumane, scamdemic shutdowns, which were completely useless. In fact, not only useless, but damaging. The insane economic stimulus as a result. Now interest rates being jacked through the roof at an unprecedented rate, which is causing a lot of consumers to put off the purchase of big ticket items like vehicles. And many consumers now cannot afford to finance a vehicle, which has forced Tesla to lower prices faster than I would have expected to keep selling through production. The very first iteration of my Tesla valuation model had gross automotive margins in 2023 for the full year in the base case of 27.9%. I'm off by about 10%. But that's a much bigger error than you would expect, because we're not talking about 10% error. We're talking about 10% off on gross automotive margin. A few years ago, I was expecting Tesla's gross automotive margins to be about a third higher than they're going to come in for the full year. That obviously has a massive impact on Tesla's fair valuation over the short term. It seems pretty clear for the full year, they're likely to come in under 20%, as opposed to my estimate, which was closer to 30%. I do think it's worth teasing this point out a little further. I don't know for sure, but we're going to find out. My suspicion is, had we not had the scamdemic and the fascist shutdowns, the insane financial stimulus, and now interest rates through the fucking roof, again, ratcheted up at an unprecedented rate, never before have interest rates increased this much in absolute terms. I actually believe that I would have probably been a little bit low on my Tesla margin estimates for 23. I think they'd probably be a little bit above 30% as opposed to just under 20%. But this is one of those examples where many investors seem to be focused like a laser on what's going on right here, right now, and not actually looking at the wider market, what's going on in the global economy, and trying to understand the reasons why there's softer demand for vehicles than there was a few years ago, causing a company like Tesla to lower their prices faster than they're lowering their costs. As I've mentioned, with autonomy around the corner, people are very quickly going to forget that these conversations were happening. But it is important to understand, because I think a lot of investors are misinterpreting Tesla cutting prices, margins coming in weaker than many expected, including myself. But again, I wasn't counting on the scandemic, the shutdowns, the financial stimulus, and rates going through the roof. I think a lot of people are misinterpreting this as a weakness or a softness for EV demand, when in fact, the real factor is that many consumers either can't finance a new vehicle, or they're thinking, rates are through the roof, the shit's hitting the fan, I might lose my job, I'm not going to buy a vehicle now, I'll put it off. In short, here's my thesis. A couple of years from now, when rates come back to reasonable levels, I think we're going to see an absolute explosion in consumers buying electric vehicles. And you may even see the same thing we saw about a year or two ago, where Tesla's forced to jack up prices to embarrassing levels to avoid stupidly long wait times. And this is in spite of them massively ramping up their global production as I record this. Only time will tell. There's a lot of moving parts here. But the point I want to make is I think most investors are misinterpreting what's going on here. We're seeing a lot of research being published at the moment, especially on Wall Street, where big brain institutional investors are suggesting that there's a massive slowdown in EV demand and own-goaling themselves into oblivion with truly embarrassing estimates. Again, I am going to call them out. Moron Stanley specifically, maybe a month and a half, 2 months ago, thinking that just 1/4 of all new vehicles sold in 2030 will be electric, because Moron Stanley are looking at what's happening globally and they believe strongly that there's actually a significant slowdown in EV demand. As opposed to a temporary delay in consumers purchasing electric vehicles, demand has not gone away. It's just been pushed out into the future until there's a little bit more certainty around the economy. And if I gaze into my crystal ball for a moment, I strongly suspect that as interest rates come back to reality, more consumers can afford to finance a new vehicle, consumers are no longer concerned about not being able to repay their mortgage, losing their job, and so on. Suddenly, the demand that Moron Stanley and many others thought had disappeared, when in fact it was just building and building and building, will be unleashed. I'll see a surge in consumers buying electric vehicles who wanted to buy an electric vehicle in 2023 but thought, not the best time, I'll wait. Now, I could be wrong, but I don't think I will be. Ask some of your friends, family, colleagues, and neighbors, will your next vehicle purchase be electric or internal combustion? Ask, are you in the market for a car now? You'll find, at least I've found, many of the people I've asked this question to are not even considering an internal combustion engine vehicle anymore, but they're also a little bit uncertain with interest rates and the economy at the moment. They're not really interested in buying a new vehicle now, but they know in a year or 2 or 3 years' time when they do buy another vehicle, it will absolutely be electric. And it's important to point this out. Between now and the point in time when those consumers are ready to buy, those who already demand an electric vehicle but have decided to delay that purchase, sentiment will have shifted so much further towards electric vehicles that if you ask the same question of your friends, family, and colleagues in a few years' time, when those who today would have bought an electric vehicle but decided now's not the right time, almost everyone you ask will only be considering purchasing an electric vehicle in the future. Again, I believe by mid-decade, most consumers, more than 50% of consumers globally, will be certain their next vehicle will be electric. But please don't tell that to companies who still think that they're going to be producing ICE vehicles in the 2030s.
What about their comments as far as production in Shanghai? Don't expect a meaningful increase in that run rate. What is that a surprise? What does that mean?
Well, it's two things. One, Shanghai was already at full production. It was really about, can we, really expand this production? And now I think he's looking at the macro environment in China and realizes that the Chinese economy is not good, and Chinese policies are not good for growth. And Xi has put China, and this is a whole nother interview for another day, but in a very difficult position economically. And so I think he's hedging his bet a little bit of how much do we want to make in China. And I think that's smart.
Okay. So recognizing that things there are a little bit soft, the potential for surprise here, what is it, Ross? I mean, do you feel like they're very smooth sailing, especially in the macro backdrop, which seems to be brewing a lot more optimistic? Because the chart's one of the few that still is technically downtrending, lower highs if we trace it back to the records. Can we turn this around on that report?
Well, I don't know if this report's going to be the catalyst to really launch it into the stratosphere again, because remember, it was trading at 100 times earnings at that time, and now it's looking more like 50 to 60 times earnings. So that multiple contraction, a lot of that is because of interest rates, to be honest, less than performance. Although performance wasn't great at the beginning of the year, and it's now improving. I think the story that isn't being told is Tesla storage. This battery storage business grew by 220%. Energy storage as a whole and solar grew by 74%. And this is the part of Tesla people just don't really talk about because it's not that sexy. But the battery business is phenomenal and growing well. And it looks like it has about a 20% margin as well. So, this is a great driver of future growth for Tesla, relevant of automotive. And now Tesla is on a run rate of being a $100 billion revenue company. And one can argue that its valuation is justified in here. And for investors, I think, there's not a lot of big cap companies growing revenue by 47%. So it's an impressive result by any means, even though margins are lower.
Well, when we look at the energy side of the business, where they are doing $1.5 billion generation and storage revenue.
On Tesla Energy, true, not particularly sexy, and this is really an overlooked aspect of Tesla's business. Tesla's large battery products, in particular megapacks, are absolutely insane money printers. The return on investment on these things for energy providers, utilities, to stabilize grids, and even for large commercial customers is absolutely insane. These are big ticket items. We're talking 7-figure purchase prices and near infinite demand. And as global battery production scales up, the cost of these products will decline precipitously over time, meaning they'll become even more of a no-brainer. And we've heard from Elon in the past, he believes the energy business itself could grow to be the same size or even larger than their automotive business. This obviously isn't including the software stuff like FSD, just the hardware sales. And we know Tesla is aiming to sell 20 million vehicles a year in 2030. So multiply that by an average selling price that isn't absurdly high, and you have some potential for how much revenue Tesla may be doing in terms of their energy products at a future date. I highly encourage investors to pay much closer attention to the growth in Tesla's energy business over the next few years and throughout the decade. Right now, it's a speck compared to the company's revenue overall, but it's growing at a ridiculous rate. Of course, there is a limiting factor, and that is battery supply. Tesla still doesn't have enough battery cells to produce all the products they'd like to, but as they can alleviate the bottleneck in battery supply with their own and batteries from other companies, Tesla Energy is going to absolutely boom.
Margins there and that portion's contribution to the stock, how big of a deal is it? Because the margin there is pretty high relative to the cars, but it's only $1.5 billion.
Well, yeah, it's not even that high relative to the cars. It's a little bit higher, but I think it's more about the future where, the car business is, becoming more competitive, more challenging. Certainly in California, Teslas are everywhere, so it's not like this new thing anymore. And so when you look at the other parts of their businesses that are super important, you've got, the charging business, which just became incredibly, amazingly valuable. And then you've got energy storage, which is a phenomenal, I would say moat that they have because no other company can do what they're doing with energy storage. And then you look at full self-driving and the software and AI component of the business, and you're like, wow. So, these other revenue drivers might not be that significant relative to autos yet, but will be over time. And I think if you look at Tesla as the whole over time, these are the parts of the business that get actually pretty exciting.
All right. 1.8 million EVs for the year, the target still. Thanks, Ross, for being here live on the earnings. Appreciate it.
But we do own Tesla. And I thought the Tesla report was actually better than the headlines. The company has been pretty clever about cutting prices to put pressure on their competitors. So yes, it's hurt their margins, but Ford just cut the price of the Lightning truck by $10,000, and their margins are significantly below Tesla.
This is true and very important. For those who don't know, Ford is losing about 40% on every electric vehicle sold, whereas Tesla's making close to 20%. In other words, real simple terms, and this is prior to the $10,000 price cut on the F-150 Lightning we just heard about. If Ford was selling an electric vehicle for $100,000, they're losing $40,000 on every one they sell before the price cut. Whereas if Tesla was selling an electric vehicle for $100,000, they're making 20 grand. Now, we don't want to get too specific here. Obviously, the higher end models that Tesla's selling, they're making higher margins. But the point, in real simple terms, if you're losing 40% on every electric vehicle sold, and then you're slashing the price of one of your electric vehicle models by a further $10,000, probably 15, 18, 20% off the purchase price, depending on the trim, Ford could be losing 50+% on every F-150 Lightning sold just to try and move through production. Now, I don't know about you guys, but I would prefer to be making 20% as opposed to losing 40 or 50% on every product sold. But hey, maybe I'm just dumb.
So Tesla has some room. And then the supercharger business looks like it's going to be significantly accretive in out years. So we like that the adoption is coming from Mercedes and from GM and Ford to their chargers. And we think that's the extension of the ecosystem that has made Apple such a great stock to own, not just the hardware, but the ecosystem. Elon's been pretty clever in that regard. And so we still like the stock. I wouldn't chase it here, but on weakness, I would add to it.
All right, 286.58 last time on TSLA. So what do you think the strategy here is, Nan, with Tesla? I mean, with the price cuts and also with less incentives being offered, obviously that hurts their margins. Are they intentionally trying to literally move stock, if not clear stock, before the economy and also demand slows down in a very increasingly competitive environment? Or are they conversely trying to consolidate or actually gain market share before things get slower?
I think it's that, Martin, because once you're in the ecosystem and they get the data and they get to continue, to utilize the data and AI, I think the company becomes more and more dominant. And it really does remind me of the Apple model when we were accumulating the stock in 2012 and 2013. Most people were focused on the fact that the iPhone, innovation hadn't been great. But what we were focused on was the services. So I think that's the majority of it. They saw some share gain in China, which kind of blew my mind. So I think you don't want to underestimate this company or this CEO. He is playing the long game, and the rest of, not the rest, but some of the EV providers are playing the short game. I think he's going to win.
Couldn't agree more. I mean, Tesla are the very definition of playing the long game, as opposed to most of the discussion in this video, which is what's happening to Tesla's gross automotive margins in the next 3 seconds. Again, I firmly believe that Tesla is on the cusp of solving autonomy. As has been the case from day one on my valuation model, I have the first robotaxi fare occurring in a Tesla vehicle somewhere on Earth in late 2024. That estimate remains unchanged. Now, it could change if new information becomes available. 2025 rolls around and it still hasn't happened. Obviously, it'll change. But I haven't seen anything to indicate that Tesla won't have the first robotaxi operating, give or take, by late 2024. And if that's the case, the financial implications are absolutely absurd, dwarfing everything else in Tesla's business by orders of magnitude. Tesla's been investing aggressively, building out a fleet of vehicles covered in sensors, collecting data. They have a huge AI team. If you're an OG nerd, you'll know about Operation Vacation. Tesla's designed their own Dojo chip for AI training. They've invested insane amounts of money that haven't yet paid off major dividends. They've built a huge fleet. They've taken risks. They've been very aggressive. Tesla truly is playing the long game. And most investors, and just about everyone in the finance media, is playing the extremely short game. And until this changes, I'm going to keep repeating myself, and I look forward to clipping these videos in a few years' time.
Shares of Tesla are under pressure after its latest results. The electric vehicle maker beat on both the top and bottom line, with revenue up 47% and delivery of vehicles above expectations to a record 466,000 cars. But Margins, they came in below expectations and hitting a 4-year low. Elon Musk warned that there could be further price cuts for its vehicles, and that could put a crimp on margins. Is Tesla a market share story, or is Tesla a margin story?
Hi, Amber. Good to see you again. I think, listen, it's a market share story. They are really trying to keep growing their market share, not just on the EV space, but in the overall car market space, and they're doing a good job there. What people don't understand about Tesla ultimately is they keep innovating, and really by innovating, they keep reducing their cost of producing these cars.
Nail on the fucking head. Tesla keeps reducing their cost to produce vehicles. Now, this isn't happening exactly in line with prices. Sometimes Tesla's costs are coming down while their prices have been going up. We saw this in the last couple of years. Now the reverse is true. But on average, Tesla's cost to produce their vehicles will continue to decline over time. This means that Tesla, as they reduce their costs over time, can also reduce the price to purchase their vehicles while maintaining steady margins and sell more and more vehicles as they ramp production globally. And remember, the whole 50% cheaper EV production platform they unveiled this year. First vehicles will be rolling off production lines in Mexico probably a couple of years from now with a significantly lower starting price than, say, today's 3 or Model Y. There are two very important sides to the equation in terms of prices for Tesla vehicles. Sometimes their costs will come down faster than their prices do. Other times their prices will come down faster than their costs do. But the trend for both over time is down.
And yeah, margin got squeezed because they had to reduce prices, but ultimately, with more market share, they're going to keep being profitable and even making more profits going forward.
Perhaps the concern about margins is that Tesla will start to resemble more and more the incumbent auto part makers, that once you start engaging in price wars, this is sort of the beginning of the end when it comes to, the wide margins that Tesla has enjoyed, which brings me to kind of the follow-up here is like, is Tesla, does it have the luxury of doing this and then extracting larger margins down the road from its installed customer base?
Listen, Tesla is worried about increasing capacity. It's a growth company, and they're investing in their growth. They just filed in Berlin new plans to increase their plan to make about 1 million new cars. So I think what they're trying to do right now is really figure out the right price for them to sell as many cars they can make, and they had enough a margin to give. That's why they were able to reduce the price of their cars. So at 18%, I'm definitely not worried about it. Most car companies have, 3-4% margins.
It's true. In short, Tesla has a shit ton of wiggle room, whereas just about every other automotive company on the planet has almost no wiggle room. Imagine you're making just a few percent on every vehicle sold, and suddenly consumers don't want to buy your vehicles at those price points. You need to reduce the price on those vehicles by more than a few percent to keep selling through production, and suddenly, why even bother producing and selling vehicles? Because now you're actually losing money on every vehicle sold. This is the precarious situation in which just about every automotive manufacturer on Earth currently finds themselves in. And I'm talking about internal combustion engine vehicle manufacturers, who one after another will be filing for bankruptcy. However, when we talk about EV makers specifically, outside of China, no one is making any money selling electric vehicles. They have less than zero wiggle room. But I'm sure they'll be fine because production is easy. At least that's what I heard on the internet.
Earlier, I talked with a guest who's very bearish on Tesla and says the stock is, I think, either worth $26 or $28. Either way, it's significantly below. You might be familiar with them, the head of New Constructs, who's just saying this is a stock that is pricing in just a totally out of this world sort of type of growth. How do you respond to that?
I may have talked to that guy.
She must be referring to David Traynor. I'm sure many of you folks who've been following Tesla for a number of years will have seen this DMF appear in the finance media being utterly wrong about Tesla every time he opens his mouth. $26 per share. You cannot take something like this seriously. There's a line. Even the dopiest of analysts covering Tesla, who are extremely bearish on the company, the kind of folks who actually genuinely think Tesla is just a car company, disregard everything else about them, still around $150 per share. To be around the $26 range, this is Gordon Johnson territory, not to be taken seriously. And then the following question, of course, is why would you say something so absurd? Of course, I don't know what would motivate somebody to say something so utterly ridiculous about Tesla and the company's valuation. Maybe you folks have a few ideas.
Listen, it's silly. This company is doing $100 billion in revenue this year, or at least their run rate is $100 billion. That's a very exclusive club to be in. They're building, 2 million cars a year. They have, 65% of the EV market, and and it's just getting started. I think the adoption of EVs is only 6 or 7% of a market that's 100 million cars a year globally. So this story is just really getting started, and I think Tesla is just the leader by years.
Just to underline that, 4 years ago, we're talking about margins, 4 years ago, revenue is $24 billion. So it's not like this has been a slow slog to $100 billion. You're absolutely right. I mean, it's astonishing the amount of growth that happened in a short time, but didn't actually occur in a short time, right? The seeds of this were planted more than a decade ago.
Yeah, and investors should not look at just 3 months, right? They should look at where this company was 5 years ago and where they're going to be in 5 years, right? Tesla is growing their top line by 50%. They grew their car production number by almost 75% last quarter. So I think the reality is they're looking, the next 2, 3, 5 years to either double or triple the production, and the margins I think will follow. I mean, even if they do 18 or 19% margins on 200 billion or 300 billion in revenue, think about how much profitable the company will be.
I highly encourage everyone watching to actually do these numbers. What if Tesla does X amount of revenue? What if their margins are X amount? How much are they printing? How many billions of dollars of profits per year? You may be surprised.
So much of consumer companies is looking at the demand side, but the equally important, if not more, is Tesla's production side of things and ensuring that and this is where a lot of the EV makers, that's why they have plunged. It is because of their inability to get it done with respect to actually building these cars, getting them off the lot. How would you characterize where Tesla stands today?
Well, I think Tesla, from a manufacturing standpoint, is so much further ahead than anybody else. A lot of the innovation doesn't just come into the car, but in the process by which they build these cars. They have the single casting thing. They have the software innovations, the way they service the car, the way even they sell the cars, right? Direct to consumer, very easy. App is really seamlessly used. So I think all these things kind of come into play, and all that basically makes for frictionless ownership, and also the ability to increase margins because there's a lot less middlemen in dealing with them.
Stock's already up so far 100% this year. It's about 30% away from an all-time high, call it 35%. How much more upside could there be?
It's a growth company, right? If they keep growing their top line and their profits, which they're fabulously profitable company at this point, their stock could go much higher.
Any ideas as to how Tesla might grow their revenue and, importantly, their profits in the next few years? Anyone? Did someone say, robotaxi? Huh? Why would you say that? They're just a car company. Athletic Greens AG1 has given me a massive, meaningful boost in energy, allowing me to do a lot more every day, including using my brain more and using my body more. I highly recommend you guys and girls check it out. Athletic Greens AG1 is an excellent way to fill in nutritional gaps. It's got 75 high-quality vitamins, minerals, and whole food source nutrients, plus prebiotics and probiotics and digestive enzymes and adaptogens to help you deal with stress. Plus, if you click the link in the pinned comment or head to drinkag1.com/SMR, you can get yourself a 1-year free supply of vitamin D3 and K2. But don't take my word for it. Here's what some of you guys and girls have to say. AG1 has changed my life. I was, as you described, treating myself like a circus, ate like trash, rarely exercised, used alcohol as a stress crutch, cannabis also. AG1 is what gave me the kick in the ass, got me back to the gym, motivated me to do more for myself, family, my business, etc. Keep doing what you do. Now, I know there's some skeptics, the same kind of people who think Elon Musk is a fraud, reading this going, what do you thought? There's no way that's possible, bro. It must be a placebo effect. Believe it or not, this is a recurring theme. If you give your body everything it needs to feel and perform its best, including having a lot more energy, you'll need ways to use that energy. For me personally, that includes more exercise, moving my body more social activity, and more cognitively demanding tasks, including producing a ton of exclusive content over on Twitter and on Patreon, plus my daily YouTube uploads. The proof's in the pudding. On to another testimonial from a viewer of this channel. SMR, you asked me to provide feedback on AG1. Here it is. It has helped with mental acuity, stamina, and intestinal waste management. Can't read between the lines. Certainly helps with regularity and digestion. That's what the digestive enzymes are for. It has also dramatically reduced my cravings for sugar. You guys need to stop eating sugar. It's fucking poison. I'm 50, 5'9", and overweight, aka a fat motherfucker. I think that's a technical term for overweight, isn't it? Is it fat motherfucker or obese? I can't remember. I average 100 hours a week in the West Texas oil fields as a safety supervisor. Jesus Christ, dude. No wonder you're struggling to keep your weight under control. 100 hours a week. Brutal. It has helped me lose weight. It is not an appetite suppressant. It can help fat people suppress cravings, and motivation to be healthier is critical for changing your diet. Love you, brother. Again, this is a great point and something people really don't seem to grasp. If you have more energy, everything becomes easier. It's like turning on easy mode for life. A few years ago, before I was taking AG1, my health was trash. I was struggling to get through the day, had afternoon fatigue. The last thing I wanted to do was either use my brain or move my body. Didn't have the energy. Now, my biggest struggle every day is figuring out ways to use that energy. I'm exercising way more, doing a lot more with my friends and family, and of course, my work output has increased substantially. And you can fact check me. Check out the average length of my videos I was posting to YouTube 3 years ago. Need I say more? And one final testimonial. Love this one. Okay, here's the deal for me with this AG1 shit. I'm 41 years old and not the type to eat, drink, smoke, or sleep healthy, so I was skeptical. That being said, here's what I experienced. Day 1, meh. Day 2, afternoon fatigue was about 45 minutes late. Day 3, 0 afternoon fatigue. Day 4, 0 afternoon fatigue plus extra energy. Day 5, again, 0 afternoon fatigue plus energy, wondering, what the fuck, really? See, this is the thing, right? The results for many people are just almost too good to be true. This is the same experience I had. My afternoon fatigue just vanished out of nowhere. I'm like, wait, what the fuck? Why am I not tired in the afternoons anymore? Surely, it's not that AG1, is it? Turns out it was. Day 6 and 7, same thing. Day 8, same thing. Plus, I had the want to get things done around the house that I normally would slack off and not get done. Again, the point, extra energy, you'll need to use it, you'll find ways to use it. Day 9, 10, and 11, and today is day 12. I fucking love it. So however you managed to get me to buy it, I'm so glad you did. Thank you so much, SMR. It really changed me so far. Guys, this shit really works. Just try it. By the way, this is the reason I continue to relentlessly promote AG1. A lot of people get real fucking mad in the comments. Oh my God, Snake Oil Salmon's sold out. Oh my God, he's a scammer. This is fraud. But constantly, I'm pretty sure everyone making these comments is also currently short Tesla stock. I'm not particularly concerned about people having a negative perception, those folks suffering from small brain syndrome, still living in my bum's basement syndrome, etc., writing mean comments, claiming AG1's a scam or it doesn't work. I mean, bro, when I get feedback like this is what keeps me going. And remember, there is a 90-day money-back guarantee. There's nothing to lose here. Just try this stuff for a month, and if you don't get these results, get your money back. See, it's a literal no-brainer. It's an IQ test at this point in time. Testimonial after testimonial after testimonial like this. Get your money back if it doesn't work. Just try it for a month, and if it doesn't work, get your money back. Today's the day. It's finally time. Be like this guy who was a massive skeptic, but finally, after 1,000 promotions in a row, caved in, tried AG1, and has results like this. Head to drinkag1.com/SMR or click the link in the pinned comment, and please, let me know how you're feeling in a few weeks' time. Now, if you'll excuse me, time to put my extra energy to good use. I'll be recording some more exclusive content for Patreon and my Twitter subscribers. So click the links in the pinned comment. See you over on Twitter and or Patreon. And don't forget to grab your AG1. Love ya.